Hi there guys, and welcome to this session on helping you choose your strategy. And obviously that's a pivotal decision that you need to make in terms of the trading direction that you're going to take. So with our time here today with the flip chart, we're going to explore a couple of different considerations for you as you build your knowledge into that particular area. And the first thing I'm reminded of is something that we developed several years ago called the paradox of trading. And really, if you think about this as a triangle as I've just drawn, there are three real components you can bring to the equation: time, dollars, and an acceptance of risk. Now, clearly with our standing order system and our done with you system with the recommendations and the My Trading Advisor app, time is really not an issue here. That's something that we've been able to take care of and demonstrate to you quite clearly that you don't need to invest a whole bunch of time. So really none of this is relevant to what we're talking about. The area that we're focused on is the amount of dollars to work with and the amount of risk that you're prepared to accept. Now, to get a bit of a handle on that, let's just consider a scale at the moment. And this scale here is a level of return. Now, obviously most people are going to want to have as high a return as possible. But there is a trade-off. The further you move along this level of return, then there are some things that you're going to need to accept. One of those is what we call the volatility of return. In other words, if you're taking on a strategy that has a higher level of return, it's likely to be a far more volatile type of return. In other words, you could make one, but you could lose one. So in other words, the range is a 200% range of between profit and loss, maximum loss versus maximum profit, which is quite high. So if you're looking for higher returns, you've got to accept more volatility in that return. Now, volatility is something a lot of people tend to shy away from because it can cause a little bit of stress. Equally, on the other side of the equation is what we call the probability. About fit that on there. The probability of return. And as we're moving down this scale of return, the higher the level of return, the less likely that is to happen on a frequent basis. Okay? So higher return, more volatile, and less probability of it happening on a more regular basis. And this is part of the reason why we choose to operate very much in this space, where we're looking for lower returns, but on a far more consistent basis, where volatility is low and the probability is relatively high. And this area in here, if we just shade this in just to really mess it up, is the area that we call covered calls. And as you know, that is our number one strategy. That's where we want to see you operating, and that's where we feel the best return on risk is available in the marketplace. It's a flagship trading strategy. Now, of course, the issue with trading covered calls is the fact that in order to do that, you need to firstly be able to buy your stock in blocks of 100 and units thereof. And that does require having a reasonable amount of working capital to go with. In fact, the smallest covered call trade that we'd recommend to get any kind of a commercial level of return is going to be in the sort of $8,000, $9,000, $10,000 level. So you can see that you're going to require a volume of cash to be trading there. Now, if you don't have that level of cash to bring to the table, maybe you've got a smaller amount of cash, well, that means that you're going to be operating at a more risky end of the spectrum. Okay, so the trade-off here is, and when I say risky, to compensate for the lack of working capital, let's say you've got a smaller amount, $2,000, $3,000, $4,000, $5,000, to get a 5% return on a $5,000 account, it's not going to help you retire that quickly. So to get the amount of capital we're working with up from $5,000, we use leverage. And in doing that, it's increasing the risk element on here. So if you think of this as a seesaw, it's getting quite a complex diagram. If you have cash to work with, you're going to be operating in the covered call space. But if you don't, then you're going to need to use leverage, which is going to increase the level of risk that you're working with. Okay, so our preferred strategy number one, is always covered calls. And then we move into what we call our directional stuff. And that's what I'm going to talk about as we move on from here. So, more specifically, if we start to look at the way we operate with our directional strategies. Okay. And we group these into a couple of areas because we want to try and get a consistent level of risk return for our clients in this space. So we've developed Directional Trader in a few ways. Firstly, we've taken an overall directional trading strategy and we've created what we call a pyramid strategy. And what that means is within the directional trading family, there are actually 3 sub-strategies that you'll trade. And the first level on there is what we call index trader. Okay. Now this is where we trade indices. For example, the NASDAQ would be a good example of what we operate within here. Now this is the place that you operate if you have a very low account balance. So let's say your account is less than $3,000. These are the kind of trades you'll be trading here. Small margin, small profit, small risk, and low transaction fee. So that's our first area. So as I say, if your account is anything under $3,000, this is the strategy that you'll be taking. Now, if you have more money in your account, well, you'll always be taking the index traded trades. But in addition to this, and this is why I say it's a pyramid or a layered strategy, if you will, within directional trader, the next area that we trade in here is what we call the reversals. Okay, now the idea of a reversal, if we were looking at a trend and things are moving up, and what we're looking for are these big pivot points. These big pivot points are what we're looking to trade. So there's one pivot point there, there's one there, there's one there. So we're looking for that reversal of trend, if you will. In order to take care of reversals, your account balance is going to be, let's say, $3,500 plus. And so you're always going to be doing a level 1 trades here, which is index trader. And in addition, you're also going to be getting exposure to some of the reversal type action as well. So there are 2 different strategies thus far within our directional trader. And then the final layer in here is our bullish directional. Now the idea of this, if your account balance is say north of $7,000, this is the strategy that you'll be doing also. So you'll be doing all of the index trades, all of the reversal trades, and then by virtue of having enough money in your account, also taking advantage of these bullish directional. Now the idea of building a strategy in this particular fashion with these 3 subsets of strategy is obviously it gives diversification. And this is very, very important because it's a huge part of risk management. Clearly all of these strategies have their own stop loss mechanisms and risk management within them too, but diversification starts to help reduce the risk by having a variety of approaches to the market. You're not using just one strategy and really plonking it over the market. Where to, in terms of this next level further up from bullish directional, well that's where you're going to be doing covered calls. So if your account balance is at that sort of $8,000, $9,000, $10,000 level, we want to see you operating in that covered call space. Why? Well, purely and simply so that you can be operating at this lower level of the volatility probability return matrix, which is really where we want to see you operating. Okay, so hopefully this gives you a little bit of clarity on how this works. So what's the next step for you? Well, everything we do here at AIE, as you know, is very sequential. And the process to get involved with this is very, very sequential too. Firstly, you need to have an open and funded account. So if you've yet to do that, please do make sure you deal with the team. Get your account open. It doesn't take very long. We can do it online for you in just literally a handful of minutes. Secondly, you're going to need to get it funded. Why? Because a unfunded account is really like a gun with no bullets. It's effectively useless. And then the third step in the process from there, once your account is open and funded, is to complete the standing order documentation and get that back to us. Now that's all contained on this page, so you can see further detail on these strategies, and you can also access the standing order document to complete it, get that sent back to us, and you can start participating in these trades. We spent a lot of time developing this strategy in this way. It's leveraged off a lot of our experience across the trading desk, and we're looking forward to helping you generate the returns that you deserve by using this simple yet very powerful mechanism.